Hey everyone, Meet Kevin here. Welcome back to another episode of the Meet Kevin Show. Last time we spoke with Harry Dent. Harry Dent projected at some point in the future a 90% correction in the market. Shortly after his interview on my channel, we started to see tech stocks, says certain online consumer discretionaries roll over. Recently, we've been seeing cryptocurrencies roll over. And folks, we've also since then announced that I'm running for governor of California. So we've got a lot of things to talk about. But I want to start with the market. And with that said, I've got Harry Dent here. Welcome aboard. Harry Dent has a free weekly newsletter at harrydent.com, obviously on the market. That's exactly what I want to start with. Harry, what is going on? And welcome back.
Well, we have this market that keeps getting pushed up only by government stimulus. The demographic trends keep getting weaker. Debt keeps going higher. All these fundamental things that cause problems starting in 2008, which I predicted 20 years before that happened, because we can tell when people are going to spend money and not. And of course, we can measure how much they're getting into debt and those sort of things. So we have this this is the 12-year rebound now, solely on government stimulus and mostly monetary policy. And now since COVID, the fiscal policy has stepped in much harder. And so it's getting more and more desperate. I've always warned that to keep a bubble like this going when the fundamental trends are weak, again, since late 2007, something we predicted way in advance would happen as baby boomers slowed in their spending. You have to stimulate more and more and more. Now it's getting extreme. So I think the markets are getting ready to crack. We've seen a series of tops here. Different markets, from the Russell 2000 and Bitcoin and now the NASDAQ and stuff. One market after the next is topping, and now we only have the S&P 500 and the Dow left. And I think those could be peaking somewhere between now and the next few weeks. And I think we're going to see a surprising crash in stocks. And by crash, I mean 40 to 50% in 2 to 3 months. Now that's a bold forecast, obviously, but it's happened before. The 29 peak, first drop out of an 89% 3-year drop was 49% in 2.3 months. 87 crashed 40% in 2 months, most of that in 2 weeks. So I see a setup like this, all this stimulus, nothing really wrong going in the world, but markets way overvalued, way overbought, and all of a sudden they just collapse. And I have this thing called a megaphone pattern. Ever since 2017, 18, that high point in the markets, we've seen slightly higher highs, but lower lows at every correction. That's telling you, Kevin, that the markets still have momentum because they've been going up so long and people are bullish and they think they're going to go higher, but the fundamentals keep failing. And the next low in this pattern is 2,100 on the S&P 500 within a couple of months from 4,200 recently. So that's the surprise that could happen. Doesn't have to happen quite yet, but my indicators say this could very likely about to happen by late May, early June, just in the next couple of weeks. So I think this will be the most unexpected crash in history.
Yikes. And now you think this sort of starting of rolling over that we've seen with some of the techs, consumer discretionaries, and recently here, Bitcoin, you think that's the start? Like those are the cracks in the ground forming before the sinkhole appears, huh?
Yeah. Well, again, I actually started with the biotech was the first. So the most risky sectors have been peaking and people keep rolling into the least risky, again, into the S&P 500 and the Dow. Interest rates keep marching up. That's another sign of a top and throughout history. So these things are coming together and everybody asked me, Harry, but there's got to be some big trigger, No, there doesn't have to be. I predicted the collapse of Japan in the late 80s, in 1989. There was no trigger for that. Stocks just got overvalued and all these things happened. And similar in 2000, there was no sign in early 2000 problem the economy when the tech crash happen, and Amazon went from 136 to 6 in a year and a half. So that's what I see happening here. You wouldn't expect it now because everybody thinks, well, the government keeps stimulating and has it under control. No, what people don't understand, the government has blown up this bubble so far now when it should have peaked in 2007, which it started to, that all it takes is nothing for this thing to go down and build momentum. And again, megaphone pattern. I'm telling you, they only occur at major long-term tops like 65, 68, and 72 when the last generation peaked. And now we have January 2018, late 2019, and now right along here, third peak, getting ready for the sharpest crash we've seen in a long time. And again, when nobody expects it.
And how long do you think something like that would last? And, you know, I mean, you mentioned megaphone pattern. That's a pretty sharp down. Is that something that you think is lasting, or is it a quick V-shape, you know, the Larry Kudlow V-shaped recovery?
Well, okay. There is no recovery from this one. That's the point. We've already had sharp downturns in early 2018 and then early 2020. Okay. They were sharp, and people say, oh, the central banks won't let this happen. They happen because markets are so bubbly. It doesn't take much for them to crack. Okay. And then government step in again. But what I'm saying, Kevin, this next one, and this is extremely clear on this chart. Okay. 4,200 to 2,100 in 2 to 3 months after all this stimulus, especially since COVID, where they just upped it exponentially. I count now about 65% of GDP, combined monetary and fiscal stimulus being approved or committed to soon, just off the charts, 50% drop when there's a disappointment. And I think that's when people, investors, finally say, oh, you know, we didn't really think you could create growth just by printing money, but it was working. When you see that sort of drop, I think the investors lose confidence, and you do not see a new high again for 15 years.
Wow. So really almost this digging out of a style of dot-com bubble disaster, huh?
This is the second tech bubble. And what you have now, the dot-coms were the leaders at the late stage of the 99, 2000 peak. And now the blockchain and Bitcoin are. So people say, oh, Bitcoin's nothing. No, Bitcoin's the next big thing, but it's early stage, and it is overvalued as Amazon was, okay, in 2000, okay? And again, Amazon went from 4 to 136 to 6 in 3 years, okay? That's this sort of bubble. So Bitcoin could do the same thing, and I think it will. I think Bitcoin now, I was thinking it might have one more run. Doesn't look like it after going down 50-some% here. If Bitcoin peaked at near 65, it's probably going to go down to about 4,000. And then I would buy it, because that's what happened with the dot-coms and Amazon and the internet stocks. In their early stage, I call it a baby bubble. You first have a baby bubble when there's a lot of promise and no substance. And then after that crashes, you have a longer term daddy bubble that is real and bubbles for better reasons, but still ends up bubbling like the internet stocks have recently. So this is a critical time. And I'm telling you, if what I say happens, and you're going to know in a couple of months here, nobody's going to see it coming. Nobody. And nobody's going to react fast enough, because how do you react to 50% crash in 2 to 3 months?
Yeah, no kidding. What's making you think that maybe people wouldn't flee over into, let's say if the S&P rolls over, maybe people flee into crypto and we see crypto do well? Is that a possibility, or will people just sell everything?
No way in hell. Okay.
Okay.
I'm extremely clear on this.
Tell me how you really feel.
Two huge misconceptions about Bitcoin and crypto. Okay. Oh, it's an inflation hedge. No, gold is an inflation hedge. Gold is going up now because inflation's going up, and gold will crash again when we go into a recession, as it did in 2008. Okay. The second thing, and Bitcoin correlates with stocks. It is the most bubbly of the bubbles. It's the bubble of bubbles, okay? It's like stocks on steroids. Stocks go up 10%, Bitcoin goes up 30%. It is not a safe haven. It will crash the most. Oh, let's just go back to March of 2020. Remember that? Just a year ago? February top, COVID comes in, a little scare in the economy. What went down the most? Bitcoin. Stocks next. High quality bonds went up. Gold went up at first and then down. The whole scenario showed you what you do in this bigger crash now in March 2020. Gold is not the safe haven because it will eventually see deflation instead of inflation. Bitcoin is the biggest of the bubbles, so goes down more than stocks. Oh, and it already just did. So I look at, Kevin, right now, Bitcoin is the leading indicator for stocks.
Wow.
Bitcoin in late 2017 peaked first, big bubble, the first big bubble in Bitcoin, and the beginning of this long megaphone sideways pattern in stocks. Bitcoin peaked and stocks peaked 5 to 6 weeks later. That puts it right at late May, early June. If Bitcoin already peaked in mid-April, it's 65,000. Stocks are next and will crash similarly rapidly when there's no good reason. Was there a good reason for Bitcoin going down? No. Was there a recession? Was there some crisis? No. Will there be for stocks? No. This bubble is so big. See, what the central banks don't get, these academic douchebags, pardon my French, okay, is that they, by trying to keep the economy from going in a recession and deleveraging debt, which they allowed to get out of control, they've created a bigger financial asset bubble. Debt's now about, I don't know, 260 trillion globally. Financial assets are at 525 to 530 trillion. That, all it takes is a crash in stocks, bonds, and real estate. It reverberates into slower spending and less wealth around the world at the speed of light, and this thing's over and you can't stop it. They're creating an avalanche by overstimulating that's just going to take one snowflake, one damn thing, bam. Wow. And it's going to happen so fast. And that's why I'm predicting this 50% crash. That's what it takes to tell the central banks, oh, you guys are not in control. Oh, you guys never ran a business. Okay. Yeah. Never had sex, most of you. Okay. You know, Janet Yellen. I mean, proof. Okay. These people in control of our economy have no sense of economic and human reality. And they're just thinking, well, when things go down, we stimulate more. And we don't want to have a recession because that's bad. Recessions are the best thing that ever happens to an economy because it cleans out a lot of bad investment and bad companies and imbalances overnight and allows you to grow again. Recessions are necessary for growth. Any economist and all of these Fed people think the same way. Oh, no, we should never. Our job is not to have recessions. Recessions are bad. If you think recessions are bad, news for you, central banks, you know nothing, zero about the dynamics of our economy and how it grows. Without recessions throughout history and occasional depressions to get rid of big debt overhangs like this, we would never have an honest business or growing economy ever again. These people know nothing about the economy, and they are running it with this endless monetary policy, which has no sense of reality. This is going to go down really bad. 10 years from now, people can look back and say, what were these central bankers smoking? And why did investors think that by simply printing money out of thin air, that's what they're doing, out of thin air, we could have sustained prosperity forever? Like in 1929, Irving Fisher said, oh, we're in a permanent plateau of prosperity. Right before the Great Depression. That's where we're at right now, Kevin. Permanent plateau of prosperity. Central banks will keep printing money and we'll never have a recession again.
So really, your argument here is, hey, look, we may have technically on paper had a recession, but because of all the bailouts essentially, or the free money,
we didn't really have that.
that
We
propped up the
didn't
companies.
eliminate debt. I've got the perfect
Right.
chart that shows the debt ratios only went down slightly in 2008-9 recession, whereas in 29 to 32, 60% of private debt got eliminated. Bad debt got flushed out of our economy. And what did we do? Grow like crazy after that. It's great to flush out bad debt. We have 20% today, public, large companies cannot pay their debt and debt service. Zombie companies are called. Now, imagine if it's 20% of the large companies, what percentage of the smaller companies have that?
No kidding. Jeez.
You got to flush out debt.
The Fed recently indicated maybe it's going to be time soon to start talking about tapering. What are your thoughts on what happens? Is that even a catalyst? Does it matter? Is it a joke? What are you thinking?
Okay, that just says it right there. These people know nothing. They think they can totally bolster up a dead economy in 2008 and 9 with endless stimulus and think, oh, now we can taper. Hey, they tried that in 2018. It's called the repo crisis. The banks started to fall apart, ran out of liquidity as soon as they just tapered a little bit. These guys, if they taper, it's like a heroin addict. Stop taking heroin for a few days. They're going to go and relapse and end up in the hospital.
Wow.
You cannot taper after this. These guys have created their own grave by overstimulating, never let the economy have recessions, and never let us clear out bad debts and bad companies. So now we got tons of bad debts, tons of bad companies, and all it takes is a little bit of tapering, and then the whole thing falls apart. These guys have no way out, Kevin. They are DOA. There's no way out of this. If they don't taper a little bit, they're dead. If their only option is to keep doubling down on exponentially more stimulus, and then that blows up the other way.
Right.
This thing is dead. There's no way out of this at this point, other than to have a collapse and let all this debt and financial asset prices, high financial asset prices equal unproductive investment. People are speculating in stocks, in real estate, and things that are not growing the economy, just going up because they're going up. And when they collapse, all that money disappears twice as fast as it was created. Twice as fast. That's another historical fact. Bubbles go down twice as fast as they go up.
How long do you see that down taking? I think earlier you mentioned it like 10 years. Do you think the 20?
No. The 29 to 32 collapse was the biggest. It took less than 3 years, a little less than 3 years. This one, I think, has been pushed a little past the cycles. The cycles would have naturally peaked last year, late 2019, early 2020, just when COVID set in. But when COVID set in, it gave them an excuse to just blow up stimulus, now fiscal, which is more powerful, by the way, on impact. More. So it takes about 2 to 3 years to wring out these excesses once the economy fails and companies and loans and banks fail, and then all this bad debt disappears. That's a good thing. Bad debts, money going into paying bad debts for zombie companies that are creating no productivity and growth disappears. They go under and clear the way for new growth. Oh, park rangers call that. Oh, let most of the fires burn. Park rangers are smarter than economists. They've learned over decades to let most fires burn to clear out the underbrush so that the next fire doesn't get bigger.
Right.
Central banks keep creating more underbrush with stimulus so each fire gets bigger. They know, I'm telling you, they know nothing. And park rangers live in the park, have to deal with real animals and real people and real natural forces. Central bankers are a bunch of academic douchebags that have never had sex and run a business and know nothing about what counts, about real human nature and economics. And that's why they're going to fail so badly.
So if there was no stimulus really or QE coming out of 2008, would that have been that larger, maybe longer term decline that maybe
that would have been 29 to 32 crash and 30 to 33 depression? We would have had much higher unemployment. All they had to do, Kevin, is let that 2008-9 recession go another year, a little more, and we would have really deleveraged a lot of debt, really eliminated these zombie companies, cleared the decks, and allowed us to grow again. No, instead, they added more debt to offset the failing debt. And now this financial asset bubble that is 525 trillion, twice as much as the debt bubble. So they use the financial asset bubble, a fire hose, to fight the debt bubble. And now they've created a bigger monster. You see how there's no way out of this. There is no soft landing to this. None possible. Jeez. There's only, they finally lose control and we have a big crash, and then all this stuff happens faster, and then we come out of it a couple years from now with maybe the idea that, oh, do we need central bankers at all?
No.
Except to provide emergency cash in real short-term situations. Central bankers are pushers, drug pushers, more and more drug. You know, feel better, get high, get high, get high. What happens when you get high and high? You come down and you crash. That's what we're going to do here. They are pushers.
Now you think after this larger correction, you're actually bullish on cryptocurrency?
Yeah. Oh, yeah. No. Well, okay. The big thing to understand here, I compare, and even the Bitcoin people don't do. I compare Bitcoin and crypto, which means really blockchain. Okay. The broader blockchain. Blockchain is the internet of financial assets, okay? Internetization, networking of financial assets. The same thing the internet did for information and communication and email, all this stuff. This does for financial assets. It's a big deal. It's in its infancy. So, like I said earlier, the internet stocks only came in the last few years of the 95 to 2000 tech bubble. And blew it up the most. Now you got to know, Bitcoin and stuff are not public companies except for Coinbase now, which is nothing. And so they're not pumping up the NASDAQ as much as the .coms did, but it is pumping up this bubble, okay? And it's going into these ICOs instead of IPOs. So this is the same thing going. It is having its baby bubble in its early stage. Bitcoin and blockchain is at 1% to 2% of what it's going to be 20 years from now, okay? I call this Internet 2.0, the internet on a 20-year lag blockchain. So it's going to go have its big early stage bubble, AOL at 400 times earnings back in 2000, one of the more substantial companies, had to crash. No company can fulfill that. Big crash. And then you go into a longer boom when you shake out 4,000 coins. Last I heard, it's 4,000 coins. Somebody told me 8. Some people say, do we need a coin? Or we have a coin when we buy pets, and we have a coin when we buy toys, and a coin. This is the greatest, stupidest thing ever happened. So it's a big explosion of innovation, which is good. It shakes down in this crash, and then the real companies and the real technologies come out of it, and they emerge mainstream. Yes, I think Bitcoin, if it survives as the standard, which is what it appears to be to me, the standard, the gold standard, when it gets up to $500,000 to $1 million a coin and is worth as much or more than all the gold in the world, it becomes the gold standard for a digital, global, not national government systems. Governments cheat. Governments print money to cheat. Governments push down their currencies to cheat and trade. All governments do is stimulate and cheat. This global currency will not allow that and will punish governments for doing that. So Bitcoin, if it becomes that, it could go to 500,000. Kathy Wood's projections are 500,000. I say 500,000 to 1 million if it does survive this crash and becomes that standard. Not a productive asset so much as that standard. And then companies like Ethereum can spawn off all the blockchain applications to make financial assets and investing in money far more efficient and low cost, and do for financial assets what the internet did for information. That's the picture. It's a big picture.
Why do you think there's a chance that Bitcoin wouldn't survive? Because you had mentioned with emphasis that if Bitcoin survives, is that something that you see as a thesis that potentially maybe it doesn't make it?
Well, first of all, the biggest companies, Bitcoin, Ethereum, Ripple, the largest companies are the most likely to survive here, okay? Bitcoin is the only one thus far that has this potential to be the standard. And it does need a standard. It needs, money always needed a gold standard all the way back to Rome and Greece, okay? So I think it will, highly likely, but something else might. But I think Bitcoin is most likely to survive. Ethereum is probably the most likely of all to survive because it's a platform for launching blockchain applications. So that's a really good thing. So I think it will, but you don't know. I tell you, every major breakthrough in history, early stages, Ford just trounced, dominated the auto industry, and then General Motors ended up kicking its ass in the end. Okay, so you don't know totally. So no, I think Bitcoin will survive. But you see after I'm going to wait after the crash and see who survives, and then I would buy those survivors just like I would have bought Amazon and the best internet companies in 2001, 2002 in the tech wreck. In this second tech wreck, I think as much as aging industries in the U.S. will do well, and Southeast Asia and India, the new up-and-coming Asian countries, now that China's slowing down, will do well. I think these Bitcoin blockchain industry will be the #1 investment here in the U.S., but you have to wait till it shakes out, buy it then, somewhere around late 2022, give or take, and look at the companies that did survive. And hold on a second. I would say Bitcoin, 95% chance of surviving, but you do not know until it happens.
You just said late 2022. This megaphone, I thought this was going to be a big, fast crash, and then that slow rise back. It was your
no.
Late 22.
The megaphone is just setting up the first crash of a series of crashes over 2 to 3 years. 1929. That's why I said 1929. It took 34 months to go from the peak in September 29 to the bottom in July 19. Almost 3 years. Okay. It was an 89% crash. This probably will not be quite as big because central banks, just even though they get wounded, they'll probably still throw out enough money to keep it from going out that much. But an 89% crash, 49% of that, more than half of that happened in the first 2.3 months. That's what I'm stressing here. That's what this is so important. When the bubble burst, bubbles do not have soft landings. Never. One bubble in all of history of any asset of any magnitude like this has had a soft landing. And people say, oh, no, governments won't let it. Oh, I heard that in Dubai in 2007 when I was lecturing there. They had the biggest real estate bubble in the world at that point. And I told that audience, this bubble's going to burst. And they said, Harry, you don't understand. The government pumps it up and won't let it. And I said, well, that's a bigger reason. It burst.
Wow.
50% the next year after I talked, late 2007, within the next year, real estate in Dubai burst 50%. A 50% crash in real estate is like an 80% crash in stocks because it's not as volatile as stocks. That was the biggest real estate crash at the time. And every single person in that audience, whether they had a headdress on or an American, told me, Harry, this cannot happen. The government will not let it. The government was pumping up the bubble. So you're going to trust them to stop the very balloon that they're blowing up? That's the problem here. Central banks have overplayed their hand to the point that when this thing bursts, it will happen. What did I say? 2.3 months, give or take, 50%, just the first crash. That's what the megaphone pattern said. But between June and August, if this plays out, not a guarantee here, if this starts to play out by August, S&P 500 and stock markets could be down 50% in 2.5 months. Do you think the Fed can react fast enough to that? No.
I mean, this sounds like the perfect spot to mention that if you need life insurance, you can go to metkevin.com/life and sign up for life insurance as low as 5 minutes. That's scary, Harry. I mean, what should a newer investor do right now?
Well, it's very simple. We've had the longest. I mean, this bull market was ordained to be the greatest in history. I was the guy that forecasted ahead of anybody in the 80s. That the baby boom was such a large generation. And with the information and computer technologies and internet coming behind them, greatest boom in history. But that boom would have been naturally over by late 2007. We've been living on all this stimulus ever since to offset the natural slowing. And now we've got even bigger bubbles, which mean we're going to have a bigger crash now than we should have had in 2008, 9, 10. So the Great Depression started with the biggest crash up front, late 29 to 32, that 3-year crash, and then a stimulus and a rally, not near the stimulus, but still a rally, and then a mini depression on the back end. This is the opposite. We had a mini depression on the front end, 2008, 9, but we blew ourselves out of it, so we're going to create the big depression and the big debt blowout and financial asset blowout on the back end. But I'm telling you, Kevin, here's the thing. Here's the thing about economists, because they're so clueless. They think what I'm saying is impossible because blah, 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 blah. The government's got this under control and won't let it happen. Well, when it happens, these very same bullish economists are going to turn around and say, oh, now we're in for a decade-long winter season, blah, blah, like 1930 to 42. I'm going to say, no, we've been in the winter season since 2008. We pushed off now, and we're going to have a deeper crisis at the back end, like 29 to 32 instead of the front end, and it's going to be over by 2023, give or take. And we're going to come out of this millennial generation. We're not going to have a decade-long dead economy, but it's going to be bad for 2 to 3 years.
Yeah, I imagine you're counter to the argument that tech companies and especially the larger companies are getting so much more efficient. Their margins are going up, and their revenues
always get more efficient. You know how they get the most efficient, Kevin? When they get their ass kicked. When companies fail and the strong survive. Efficiency is always happening. Innovation's always happening. But booms and busts and cycles innovation all occur in cycles. Okay. The problem with economists is they think they can create an economy that's like a machine that grows at 3% with 1 to 2% inflation and no recessions. If you think that as an economist, I am telling you, and I will shoot myself, okay, in 3 years if this doesn't happen.
No,
you know nothing about the economy. If you think you can turn it into a machine, it is a dynamic play of inflation and inflation, boom and bust, recessions, depressions. All of this is what creates innovation. You do not have innovation without this dynamics. They don't want the dynamics. They want to create heaven on earth. Okay? That means to me, they understand nothing about economics. I don't care what they've studied. Ben Bernanke understood the Great Depression enough to blow a bunch of money up to create it because he knew how bad it could be. He still does not understand how much our prosperity benefited from that great detox of our economy in the 30s after a bubble like this.
Well, now I'm very curious to hear your opinion on what it's going to take to fix California.
Well, you know, California, California's been the leading edge of this country. I was there for 22 years. I moved there and I was happy for a long time until prices kept going up, traffic kept getting worse, and homelessness kept getting worse.
Now it's bad.
It's the leading edge of technology, though. I mean, what state? I mean, okay, New York has the financial markets, okay? California has Silicon Valley, technology, and Hollywood. Guess what we're most respected around the world for? Forget technology. It's Hollywood. You go to a foreign country and kids come up to you, they want to know, and you're from the US, they want to know what movie star you are. They don't know if you're Steve Jobs or with a tech company. So these are the most productive industries. California has been the leading edge of this country for a long time, but it's also the biggest bubble. And it's also slowing because why did I leave there? Because it's so expensive and the bureaucracy and the traffic. I used to be in the Oakland Hills with these giant binoculars. I wouldn't leave my house without looking at all 3 bridges and all the traffic. It was just, constipated. So California really will continue to be. I mean, we've always grown from east to west, all of human history, modern history, from Greece and all that stuff in the Middle East towards here, now towards Asia. So the West Coast is still the leading edge of this country, but the leading edge after it's been China in this boom and in Taiwan and South Korea and Japan, East Asia, the leading edge is going to be Southeast Asia and India. And the leading edge of this country is still going to be the West Coast, which is the closest to that and still the leading edge. But California has the most overvalued real estate overall, and has just needs a lot of reforms to come out of this. Success creates complacency. And so success, ultimately, that's why you need recessions to wake people up. Just when they get complacent, recessions wake people up, force them to cut back, reassess things. California and the West Coast is going to be the leading edge of our economy in the future, even though we're going to grow slower in the future. And it needs the biggest overhaul right now.
And what does that look like to you, that kind of overhaul? Because you do have a lot of people and businesses voting with their feet. They're leaving to Texas, they're going to Puerto Rico, they're going to Florida, they're going to no income tax states, and they're taking their businesses away because the regulation is insane. It's impossible to do business. You pay taxes like crazy, and yet you look around, the government's not even helping people prevent dying on the street with homelessness, and the traffic's horrendous. What would it take beyond a recession? I mean, is it something that can be solved?
Reality. Okay. If you're in California, what do you love the most? Real estate. Your real estate's going up forever. It keeps going up. People say to go down. No. Real estate is the problem in California on top of the traffic and everything else. Real estate is that's why I had to leave. I moved to Miami and saved money in real estate, and Miami's a bubble. Okay. I'm in Puerto Rico now. My God, I'm buying a house for a fraction of what it would cost in Miami, and then another fraction of San Francisco or LA. Real estate's the problem. Unless you have this shakeout in the economy and all this debt write-off and stuff, real estate will come down, and that will free up California. Everybody just needs this detox to get rid of all the zombie companies, and there's tons of them in California, bring real estate down to reality. Is it going to come down a lot in Omaha? No. Dallas? No. It's going to come down the most in Manhattan, San Francisco, San Diego, LA, Miami, and places like that. They're the most bubbly. And then these places, which are bubbly because they're the most innovative, will come out of this stronger. California needs this detox. And yes, you have to get back to fostering more housing, lower prices, and fostering innovation and business, and not taxing the hell out of them. California is not, they tax everything. I was like, even gasoline's 80 cents more a gallon than somewhere else. There's nothing they don't tax. Unless California says, wait a minute, yeah, we've been doing all this to keep up with the high real estate prices. Everybody's getting a bonanza off this, but California's sinking from its high real estate prices, you idiots.
Wow.
How can high real estate prices be good for the competitiveness of any city or any state or any economy? It increases the cost of businesses and reduces your competitiveness.
Yeah, I mean, California is definitely losing in terms of competitiveness. I mean, I even hear the movie industries are starting to move out to Texas and other areas.
Make movies in Austin, or in Miami, but that's cycles though, Kev. Things succeed. Success creates its own complacency and higher costs and stuff. And then you have to have recessions to force people to get back down to reality. California will be the leader again only if we have this downturn and its real estate and its inefficiencies and taxes come down. Because I would never, ever move there again. I moved out in 2002, never moved back the way it is now. And I was in San Francisco when homelessness was bad. Now it's out of control.
It's very bad now. Everything's gotten worse in the last 17 years, with homelessness especially. So outside of the market and sort of the natural real estate cycle, Can California start changing in the way of maybe incentivizing more development, loosening regulation, lowering taxes, and ending homelessness to at least improve? And again, separate from the market cycle, can California be fixed in that sense?
Yeah. They're playing into the cycle, higher cost of real estate and doing business and regulations because of high population and all this stuff and scarce water. I mean, California has some reasons that they're playing into it. They're just increasing the cost spiral. They have to go the opposite. They have to say, look, we have to take some hits now. We have to find ways to reduce taxes, attract growth businesses again. Because you're right, all the growth businesses of the past are leaving. Tech companies are going from San Francisco to places like Austin, Texas, where it's hip and lower cost. I mean, the cost of real estate is a fraction. So they have to say, no, our success is now our failure. We have to restructure for a new success. We have to become lower cost of living. We have to become more business friendly. Oh, no, we can't. And we have to do it without killing the environment, because you have less water and a lot of restrictions that someplace. I mean, Florida's got plenty of water. Okay. California doesn't. Okay. So that's a reality. So you have to deal with the environmental stuff, but you have to say, we have to restructure to be a lower cost, more business friendly place to live. Otherwise, we're going to keep losing people to the Southwest and even back to places like Florida and Texas.
Wow. So in addition to these structural changes, getting government out of the way in that sense, I want to ask your opinion, and then we'll wrap up because I know we've got a limited time. I want to ask your opinion on the government's role in education. I have this brief plan. I'll give you a very brief overview of future schools. And future schools combine vocational schools with trade school. Well, I mean, trade schools with high school, college, and financial education. So that by 18, people are actually educated so that they don't have to be dependent on the government, don't have to get into hundreds of thousands of dollars worth of student debt. And we actually work with growth industries to create the kinds of workers that our society needs. What's your take on the government's role in fostering that kind of education?
Okay, number one. We've been teaching standardized education where everybody learns the same stuff and some people learn it fast or not. Forget that. The job of teachers in schools, especially elementary and high school, is to early on identify people's strengths and weaknesses. What can they learn the best? What are where can they excel the most, and give them more of that. And like you were hinting at, combine academic education with practical experience. Makes kids go out and do real projects. At Harvard Business School, I had to do a whole marketing project for a Fortune 100 company, a team of 5 people in my class. So we really had to not only learn stuff, but actually do stuff in the real world and see if it works or not. So we need a combination of academic and real world experience. But the number one thing, don't teach everybody the same stuff. I wasn't good at English and English lit. I was great at science and math, okay? I should have taken more of that and focused that, find out where I have the great. There are so many personality and aptitude tests now. You can determine in a day what somebody's strengths and weaknesses and where they can excel more or not. You still have to learn a little bit of everything, but get people focused on what they do best and don't teach everybody the same stuff. Customized education from an early age, not just in college.
Yeah. Start. My plan would call for starting at 14, but you're right. I mean, you could probably even start earlier, but you got to start somewhere.
Right at adolescent. That's when you start. You teach everything, in grade school. From junior high up, you start focusing people more and more specific in what they do best, and cultivating that. And again, cooperate with the business and government communities and get people real experience as well. Don't just have them sit in academia until they're 22 and get out and say, well, what do I do now?
Bingo.
People should know already what they're good at and what type of jobs they're good at, because they actually had some summer jobs in between and found out not just academically, but where they actually excel. Best thing I did was went to Switzerland, and worked for a summer. And actually, in that case, I learned that I wasn't a corporate guy. It was a huge lesson. I learned, I thought I was supposed to come out of Harvard Business School and be a corporate guy. I worked for W.R. Grace in Switzerland, Lausanne, and realized I am not a corporate guy and should never work in corporate America. And that was my biggest insight. By doing something in the real world and testing it out instead of just getting more education.
Yeah, very true. I love that. Golly, Harry Dent, this has been incredible. I know you have a free newsletter at harrydent.com. Can you tell us a little bit about that?
Yeah. Every week, I and my partner, Rodney, have an article, and I do rants every other week, like I just did today, this morning. So this is the way we keep in touch. We know that we're saying something different than people think. So I say, look, if we sound interesting, get to know us. You can do it for free. Now, once you see, oh, okay, I like this. Okay, we have, monthly newsletter that's much more in depth, but you can get to know us and a lot of good information for free until you come to the decision, I like these guys or not. And I'm telling you, this is a good time to like us, okay? Because something's going to happen here that nobody is going to see. Literally nobody.
That's incredible. Harry Dent, this has been a pleasure and a blast. Very, very interesting perspective. You're right, it's different, but honestly, everybody should be thinking about it and considering it. So thank you so much, harrydent.com. For everybody watching, if you found this helpful, consider liking, sharing the video, and subscribing. Harry Dent, stand by for one moment. Thank you so much for being here, and we will end the broadcast. Thanks, everyone.